Hello, ladies and gentlemen, and welcome back to another episode of Investing for the Common Man. My name is Luke, and my mission is to help you save not only your money, but also your time. Today, we are going to look over all your options when opening a brokerage account. We'll also look at the tax advantages of each, as well as their restrictions, and how to decide which type of account is the best choice for your financial situation. As always, please subscribe and smash that like button for the YouTube algorithm. Alright, let's kick it off by discussing your standard brokerage account, often referred to as an individual brokerage account. A standard brokerage account essentially offers you no incentives and no restrictions on what you can and can't do with your money. You can deposit or withdraw any amount at any time without penalty. You can also choose to be as passive or active with your investments as you like, and can be approved for full margin, options, and futures trading. Margin is when your brokerage firm will lend you money against the cash or assets in your account. This can increase your liquidity, flexibility, and buying power. The downside of an individual brokerage account is that you will not receive any tax incentives. So if you deposit $10,000 in a standard brokerage account and then buy and sell assets favorably until your account grows to $15,000, your realized gain, which in this case is $5,000, will be subject to taxes. Now, how you'll be taxed on that $5,000 is where things will get a little bit tricky, so stay with me here. If you held an asset like stock for less than a year and a half before you sold it, then the realized gains will be added to your yearly income and taxed according to your appropriate tax bracket. If you hold an asset for longer than a year and a half, you'll be subject to capital gains tax, which will always be less than the rate of your income tax bracket. Now, if your income is less than $40,000 per year or $80,000 if you're filing jointly, your capital gains tax rate is 0%. If you make more than that, your capital gains tax rate might be 15 or 20%, depending on your tax bracket. Since you pay taxes on realized gains within the account, you will not have to pay any additional taxes when you remove funds from the account. To summarize all that technical jargon, individual brokerage accounts are good for investors with short to intermediate term investment goals, and investors that want the maximum amount of freedom and flexibility. This is also the preferred account type for traders who want to actively manage their investments and do more trading. Now, accounts specifically designated for retirement work a little bit differently. All of them have some sort of tax incentive, but those incentives come with certain restrictions on how much and when you can deposit or withdraw money from those accounts. The most common retirement accounts are called IRAs, which is short for Individual Retirement Account. There are several different types of IRAs, but we'll just cover the most common two today. With a traditional IRA, contributions are tax deductible, which means if you make $60,000 a year and deposit $6,000 into your traditional IRA, then you will only have to pay income taxes on $54,000. Realized gains within your IRA are also tax deferred, so as you buy and sell assets, you don't have to pay any taxes on your realized gains until you withdraw money from the account. A Roth IRA, on the other hand, differs in that the money you deposit is not tax deductible. So in our previous example, you would still have to pay income taxes on the full $60,000 salary. But the trade-off is that you will not have to pay any taxes at all on withdrawals in retirement. This way, you pay taxes on your retirement savings before they ideally appreciate significantly in value. The general rule of thumb is that if you think your tax rate is going to be higher in retirement than it is now, then you should go with a Roth IRA. If you think that your tax rate will be lower in retirement than it is now, then you should go with a traditional IRA. The math can get a little bit tricky and there's a few unknowns, but for most people, a Roth IRA is significantly more beneficial and will also guard you against the possibility that the government raises taxes in the future. One quick note, if your income is greater than $124,000 per year, then you are not eligible to make contributions to a Roth IRA. Now, all of these incentives are amazing and can save you tens of thousands of dollars in the long run. but it is important to fully understand all of the restrictions that come with these tax incentives. Since these are designated as retirement accounts, you cannot withdraw funds from an IRA before age 59 without incurring a penalty. There are a few very specific circumstances referred to as hardship withdrawals under which funds can be withdrawn without penalty, but generally you should not deposit any funds into an IRA that you believe you will need before retirement. IRAs also have a maximum yearly contribution limit. The limit is currently $6,000 if you are under the age of 50 and $7,000 if you are over the age of 50. One person can have multiple IRA accounts or even both a traditional and a Roth IRA, but the maximum combined contribution to all IRA accounts is still the same per year. IRAs are also strictly cash accounts and cannot be approved for margin. This means that you can't utilize increased buying power, day trading, or use some option strategies that require margin. In addition, the custodian of your IRA may have additional restrictions on what types of securities you can hold in your account. Generally, IRAs are used to hold predominantly stocks, ETFs, mutual funds, and bonds, but other assets can also be held in such an account. The other type of retirement account you've likely heard of before is a 401k. 401ks are unique because you cannot open one on your own. The only way you can receive a 401k is through your employer. When you start a new job, you may be given an opportunity to sign up for your employer's 401k program. Some employers even offer a matching 401k, where for every dollar you contribute out of your paycheck, they will also contribute a certain amount to your retirement account. If your employer offers a matching 401k, you should absolutely take advantage of what is essentially free money. The tax benefits of a 401k are essentially the same as a traditional IRA, where your contributions and account growth are tax deferred until you withdraw funds in retirement. One benefit of a 401k is that the maximum contribution limit is about 3 times higher than an IRA. The downside of a 401k is that you are severely limited on what types of assets you can hold in your account. Your employer will typically select which mutual funds or ETFs you are able to invest in within your 401k, and generally you will not be able to buy or sell individual stocks or derivative assets. 401ks are specifically intended to be passive investment accounts. Those three are the main types of retirement accounts used by the majority of Americans. If you're a business owner or self-employed and make a considerable amount of money, you might have the option to open a solo 401k or an SEP IRA account. This doesn't apply to most people, so I won't go into depth about them here. But if you have questions about these accounts, I'd be happy to answer them in the comments below. The last type of investment account I want to cover today is a 529 higher education savings account. A 529 plan is a tax-advantaged account designed to encourage saving for education expenses of a designated beneficiary. These plans are predominantly used by parents saving money for their child's college tuition. Contributions to a 529 plan are made after federal income taxes, but some states do offer contribution deductions against state income taxes. Contribution limits are set by the states and can be quite high, but to avoid federal gift tax consequences, the maximum a single taxpayer can contribute is $14,000 per year. Once deposited, funds within the account grow tax deferred, and any withdrawals made for the designated beneficiary's education expenses are exempt from taxes. If there are any funds left over after the designated beneficiary's education expenses, they can be used to cover other education expenses of another family member of the primary account holder. Withdrawals from a 529 for any other reason before or after education expenses are subject to standard capital gains tax rates, as well as an additional 10% penalty tax. The tax benefits of a 529 account can be highly advantageous, but it is very important to note that transactions within a 529 plan are highly restricted. IRS regulations allow a maximum of 2 exchanges or reallocation of assets within a 529 account per year. This restricts an account holder to only passive investing strategies. Okay, let's just do a quick recap. I have made a chart here to compare all of the different account types we've covered today. both their tax benefits and restrictions, and what types of investing strategies are possible with each account. There is no penalty or limit to having multiple account types in your name. If I were to sum up my personal advice for the average American, to save for retirement, a Roth IRA will likely be your most advantageous option. In addition, if your employer offers a 401k plan, you should definitely take advantage of that, especially if they offer any matching incentives. Saving for retirement is important, but there are many other expenses in life that you should also save and invest for. Regardless of whether you want to be an active or passive investor, I believe that every person should have a standard brokerage account to save for any short or intermediate financial goals, like a car, house, or building a nest egg. In my humble opinion, individual brokerage accounts are generally superior in every way to the common savings account. Most brokers even offer interest rates on cash holdings within your brokerage account that are on par with most low-yield savings accounts. I know that this is a lot of information to digest all at once, so if you have any questions, I'd be happy to answer them in the comments below. Please don't forget to subscribe and smash that like button for the YouTube algorithm. Until next time, keep calm, stay healthy, and happy trading.